LLC versus S Corp explained. Starting a business involves making several critical decisions, including choosing the right legal structure. Two common options for small businesses are the Limited Liability Company, LLC, and the S Corporation, S Corp. Each structure has its advantages and disadvantages, and understanding the differences between them is essential for making an informed choice that suits your business needs. In this guide, we'll explain the key distinctions between LLCs and S Corps to help you make an educated decision. 1. Ownership and structure. LLC. An LLC is a flexible business structure that can have one or more members. Members can be individuals, other businesses, or a combination of both. The structure is generally more informal, with a less rigid organizational framework. S Corp. An S Corp, on the other hand, is more structured and formal. It can have multiple shareholders, but it must be a domestic corporation with specific requirements, including a limit on the number and type of shareholders, individuals, estates, or certain trusts. 2. Taxation. LLC. LLCs offer flexibility in terms of taxation. By default, they are treated as pass-through entities, meaning that profits and losses flow through to the individual members, who report them on their personal tax returns. However, LLCs can also elect to be taxed as a C corporation or an S corporation, depending on their financial goals and tax strategies. S Corp. S Corp, by their nature, are pass-through entities. Income and losses are passed through to the shareholders who report them on their individual tax returns. This structure helps S Corp shareholders avoid double taxation at both the corporate and individual levels. 3. Self-employment taxes. LLC. In an LLC, members are typically subject to self-employment taxes on their entire share of the company's profits. This can result in a higher overall tax burden. S Corp. In an S Corp, only wages and salaries paid to shareholders who work for the company are subject to self-employment taxes. Distributions, which are a common form of income for S Corp owners, are not subject to these taxes. 4. Formalities and compliance. LLC. LLCs generally have fewer formalities and compliance requirements than corporations. While LLCs do have some reporting and operational requirements, they are typically less burdensome than those of corporations. S Corp. S Corp have more formalities to adhere to, such as annual meetings, minutes of meetings, and stricter record-keeping requirements. Failing to comply with these formalities can jeopardize the S Corp's tax status. 5. Limited liability. LLC. The primary benefit of an LLC is limited liability for its members. This means that members' personal assets are generally protected from the company's debts and legal liabilities. However, there are exceptions, such as instances of personal guarantees or gross negligence. S Corp. Like LLCs, S Corps provide limited liability to their shareholders, protecting personal assets from business debts and lawsuits. 6. Stock and ownership transfer. LLC. LLCs have more flexibility in terms of transferring ownership. Members can usually transfer their membership interests without needing approval from other members. However, the LLC operating agreement may outline specific restrictions. S Corp. S Corps typically have more restrictions on ownership transfer. There are limitations on the types of shareholders and the number of shareholders an S Corp can have. Additionally, the transfer of S Corp shares often requires the approval of existing shareholders. 7. Profit allocation. LLC. Profit allocation in an LLC can be flexible and doesn't have to correspond directly to the members' ownership percentages. The operating agreement can outline different allocation methods, allowing for customization of profit sharing. S Corp. In an S Corp, Profit allocation is generally based on the number of shares owned by each shareholder. This can be less flexible than the profit-sharing options available to LLCs. 8. Record keeping. LLC. LLCs typically have more straightforward record-keeping requirements. They are not required to maintain the same level of detailed records as corporations. S Corp. S Corps are subject to more stringent record-keeping and reporting requirements. They must keep detailed records of meetings, decisions, and financial transactions. 9. Management. LLC. LLCs can be managed by their members or by appointed managers. This flexibility allows members to choose the level of involvement they want in the day-to-day operations of the business. S Corp. S Corp have a more traditional corporate structure with shareholders, directors, and officers. Shareholders elect directors who, in turn, appoint officers to manage the company. This structure can be more formal and hierarchical. 10. Conversion possibility. LLC. An LLC can elect to convert to an S Corp or a C Corp status if the business's financial situation and tax goals change. S Corp. While an S Corp can convert to a C Corp or another business structure, it generally cannot change to an LLC without first terminating its S Corp status. 11. State-specific regulations. LLC. The regulations and requirements for LLCs can vary from state to state. It's important to understand and comply with the specific rules and reporting obligations in your state. S Corp. S Corps are subject to both federal and state-level regulations. Compliance with state laws is crucial to maintaining your S Corp status. 12. Transitioning to a C Corp. LLC. Transitioning from an LLC to a C Corp can be relatively simple. However, it's important to consult with a tax professional to ensure a smooth and tax-efficient transition. S Corp. An S Corp can transition to a C Corp, but it can be more complex. It often involves liquidating the S Corp, which can have tax implications for shareholders. Conclusion. The choice between an LLC and an S Corp depends on your business's specific needs and goals. While LLCs offer flexibility in terms of management, taxation, and ownership, S Corps have more formalities and compliance requirements but can provide potential tax benefits and the advantage of limited liability. Before making a decision, consult with legal and financial professionals who can help you understand how each structure applies to your unique circumstances. Consider your business's size, growth potential, and long-term objectives.